prior to getting into specific examples that I want to share with you about how we go about building a property portfolio for our clients, I wanted to cover a little bit of the theory about our portfolio approach. So to begin with, I wanted to have a look at some data. So in this chart, we can see the 20-year average price for both houses and apartments across the Sydney market. And we're going to have a look at both Sydney, Melbourne and Brisbane markets and see how they compare. But one key insight out of the Sydney chart that I want you to take note of is these two periods here. Between 1998 and about 2000, Sydney experienced some fairly significant growth. And then between about 2000 through to about 2012, Sydney was pretty much tracking sideways. And then between 2012 and 2018, again, some very strong growth. So over the long term, there's been some fairly strong growth. However, in this middle period here, being very flat, it teaches us a very valuable lesson about property investment. We need to consider property investment as a long-term endeavor. And when we go into this mindset, even if we bought in the middle of the cycle here, which of course we'll try to avoid, but even if we did that, we're not going to hold on to it between 2007 and 2012 and get frustrated and sell our property saying, property is not the right investment for us. And because if we did do that, we'd miss out on all this capital growth here, which is going to deliver us over the long term the growth in our net worth and ultimately the passive income we need to live the lifestyle that we deserve in our retirement. Melbourne's a fairly similar story. Between 1998 and 2007, fairly strong growth. But since 2007, although reasonable growth, has tapered off compared to the previous 10 years. And this is true in both the housing and the apartment market, which you can see are fairly correlated in their growth patterns. But one of the things I asked my in-house research team to have a look at, specifically with Melbourne, which is actually true across Sydney, Melbourne and Brisbane markets, is we had a look at the 20-year average capital growth rate, and as well as we looked at the current yield for both houses and apartments. And what we started to notice was that over the long term, houses tended to have a higher capital growth rate when compared to apartments. However, conversely, apartments tended to have a higher yield when compared to houses. So what does this mean? Basically, in order to capitalize on this higher growth rate with houses, it was going to cost us more to hold on to those particular assets. So when we're looking at building a property portfolio for people, one thing we need to consider is we need a combination of houses, apartments and townhouses in our portfolio, because they all have different pros and cons. Houses tend to grow faster in capital growth, but it costs us more to hold them. Apartments, lower capital growth, but it costs us less to hold them. So we need to diversify in the types of assets we acquire in our portfolios in order to manage our cash flows so we can hold on to them for the long term and allow the capital growth to deliver us the net worth and ultimately the passive income we need to live the lifestyles that we deserve. So there's no real answer between houses versus apartment, which one's the better investment. We need both. In Brisbane, again, very similar to Melbourne here, consistent capital growth story between 1998 and 2007. And since 2007, we've seen fairly average growth, just like that period we saw in the middle here with Sydney. So what does that teach us? Well, it teaches us that markets operate on different cycles. And what we can see here between the median apartment prices between 1990 and 2016, we can see the red line here is Sydney. And there's a couple of interesting insights that we can take out of this particular chart. The only other capital city that's ever overtaken Sydney's median house price is this orange line here, which is Perth. Now, can you have a guess why Perth overtook Sydney's median apartment price? You got it, the mining boom. But the main insight I take out of this particular chart is comparing the red line of Sydney here, which is always, other than the Perth example, been historically the most expensive, and the light blue line here, which is the Brisbane price line. What you can see is whenever there's quite a large gap between the Brisbane and the Sydney median apartment price, Sydney tends to track sideways, while Brisbane tends to go through a little bit of a boom. It's almost like an elastic band. When it stretches out far enough, it's got no choice but to snap back. And the story here is affordability. So now we can see the Brisbane price, median price, has been tracking fairly consistently over a long period of time, about 10 years, whereas Sydney has gone through a massive boom that we've all experienced. So what does that tell you about, or what assumptions can you make about what's in store from Brisbane? From an affordability standpoint, there are so many people moving from Brisbane to Sydney. And so what does that mean for us as investors? Well, it means that we need to have a diversification in the locations that we invest. So not just a diversification in the types of assets we're purchasing, but also a diversification in the areas that we're investing, because each market operates on a completely different cycle. So we want to spread out our assets and not have all of our eggs in one basket. What we can see is over 20 years, however, across properties in the eastern states, including both houses and apartments, have grown on average at a rate of 7.17%. And that means, according to the rule of 72, and I encourage you to Google this, means that the properties on average have doubled every 10 years. So, with that in mind, this is exactly how we came up with our portfolio approach. It's a system, a methodology in order for people to invest in property over the long term to achieve their financial goals. And it's so simple in nature, but people don't, because it's so simple, please don't disregard the power of this portfolio approach. And the portfolio approach is as follows: 4 or more properties. Why 4? Well, in terms of net worth, you need about 4 or more properties to hold on to them for about 10 to 15 years, which is enough time, even if we get it a little bit wrong, for those properties to double in value. And that net worth that you generate of somewhere between $2 to $4 million will give you enough passive income for the average Australian to live the lifestyle that they deserve in their retirement. So that's why 4. We need to have a long-term mentality. Markets or property does not always go up in a linear fashion. However, if the fundamental drivers are there, it will go up over the long term. But we need to be able to hold on to our properties for at least 10 to 15 years to give them a chance to double in value. We need to have diversification of our asset types. So as we saw in this example, houses tend to have a higher capital growth, but a lower yield, meaning they're more expensive for us to hold on. And the reverse is true for apartments. So we need to have diversification in the types of assets that we're holding within our property portfolio to ensure that our cash flow works out in order to give us the ability to hold on to them for 10 or more years to give them a chance to double. And as we also saw through the data prepared by our in-house research team, each market operates on its own cycle. There is no one overall Australian property market. If Sydney has just gone through a recent period of boom and Brisbane's been flat, well, if we hold all of our properties in Sydney and we assume that the Sydney market's going to taper off or at least hold steady for a period of time after its big boom, if all of our assets are in Sydney, well, we're not growing our net worth and we need to wait for the next cycle. But if we have a diversified property portfolio over at least 2 cities, then we can capitalize on the different market cycles within those cities.